It feels not that long ago when we had this beat all to ourselves over here in the mining sector, mining.com, Northern Miner. Now it is an absolute avalanche of news on the critical minerals, metals. It is the front page news almost daily here. Whether it's the new records in gold, as we had yesterday, whether it is the landmark agreement between Australia and the United States, also signed yesterday. There are actually two headlines that could have been world headlines competing with each other. That is the state of things here in 2025. And another interesting aspect of it is it feels like this story, this critical metals story, this shortage of metal, this story is going to be with us potentially for years. So what does that mean? Hello and welcome to the Northern Miner Podcast. My name's Adrian Pocobelli in a changing world. Truly a changing world. And as I often mention here, just another example of the cyclicality of this industry and perhaps even of life in general. This industry going from 0 10 years ago to hero in terms of significance, attention, and importance in just a decade. And that is quite something. So let's take a look. Trump signs agreement on critical minerals with Australia. This is Bloomberg News via mining.com. And this is October 20th. President Donald Trump signed an agreement with visiting Australian Prime Minister Anthony Albanese to boost access to critical minerals and rare earths as the U.S. looks to reduce reliance on Chinese supplies. Trump said on Monday at the White House during a meeting between the two leaders, quote, "In about a year from now, we'll have so much critical mineral and rare earths that you won't know what to do with them." The thought has crossed my mind. Trump is probably right. We are probably going to have an overbuild of rare earth and critical minerals here, but they probably don't feel like they have much of a choice. Albanese said the deal represented an $8.5 billion pipeline that we, quote, have ready to go. He hailed the Minerals and Rare Earths Pact as taking the nation's economic and defense cooperation, quote, to the next level. The leader said the agreement would include Australian processing of rare earths, with Albanese adding that Australia had capacity to expand those efforts. The U.S. and Australia pledged to protect their domestic markets from unfair trade practices, including through adopting trading standards that involve, quote, price floors or similar measures, according to the text of the deal circulated by Albanese's office. So price floors return to the conversation. They are becoming a chorus. And of course, that is a little more controversial than subsidies because, of course, we're starting to move into price controls. It'll be interesting to see if this works because, of course, you could argue it simply shifts the concern up the supply chain to manufacturers who are going to have to pay more for their components against their Chinese rivals, should price floors be necessary. The deal will begin with the U.S. and Australia each paying more than $1 billion over the next 6 months for initial projects, with some further projects in both countries and one development to include Japan, the Australian Prime Minister said. The document did not include details on which entities would provide that financing. The Pentagon will help fund the construction of a 100 metric ton per year advanced gallium refinery in Western Australia as part of the deal, according to the White House. The sit-down, Albanese's first White House visit since Trump retook power, comes as the Australian leader looks to shore up ties with the United States using his nation's wealth in critical minerals as leverage. China's move to impose unprecedented export restrictions on rare earths has rattled economies across the globe, with U.S. Treasury Secretary Scott Bessent saying last week that allies, including Australia, are in talks about a united response. And perhaps the main motivation behind this whole deal, if we had to speculate, is in the following paragraph. Australia, which holds the world's fourth largest deposits of rare earths, has sought to position itself as a viable alternative to China for supplies crucial for industries covering semiconductors, defense technology, renewable energy, and other sectors. And here is the key. The country is also the base of the only producer of so-called heavy rare earths outside China through Lynas Rare Earths. So, of course, as we've discussed here previously, 99% of heavy rare earths are processed out of China. So this is important because oftentimes these are the rare earths with particularly useful military applications, including for missiles, radar, and some of the most cutting-edge technologies. As I've mentioned in the past, in a sense, the supply of rare earths, one could argue, are the key to the future of the world economy. When you think of robotics, automation, the next generation of cars, battery technology, all of it. So a big deal between the United States and Australia. I mean, the big question here is, where are we going to be in 6 months? Is this going to make the difference? How fast, as Trump says, before you're going to have more than you know what to do with? How long is that going to take? So, of course, we had the story from last week, G7 set to discuss joint response to China curbs on rare earths. So, rare earths are at the top of the global agenda here, the G7 putting out a joint response, as Scott Besant was mentioning in the previous article. And in the next story, interestingly, you see why. And here's the headline: Automaker Group warns Nexperia chip supply issue could quickly disrupt U.S. production. This is Reuters via mining.com. I mean, some people are saying, I think rightly, China could shut down the whole global economy if they wanted to. It's quite a statement, but it seems, at least for automakers, they are facing an existential issue here with the supply of these metals and minerals. And this is Reuters via mining.com. A group representing major automakers warned late on Thursday that a chip disruption stemming from a dispute between China and the Dutch government could quickly impact U.S. auto production. Car makers and their suppliers received notice from chipmaker Nexperia last week that it could no longer guarantee delivery of its chips, said ACEA, the European Union's auto association, which also said manufacturing could be significantly disrupted. In the United States, the Alliance for Automotive Innovation, which represents General Motors, Toyota, Ford, Volkswagen, Hyundai, and nearly all major automakers, urged a quick resolution. And here's a quote from the group's CEO, John Bozzella. Quote, "If the shipment of automotive chips doesn't resume quickly, it's going to disrupt auto production in the U.S. and many other countries and have a spillover effect in other industries. It's that significant." Some automakers told Reuters that U.S. auto plants could be affected as soon as next month. They declined to be named due to the sensitivity of the issue. The chips made by Nexperia are crucial to production of U.S. parts and vehicles. The Dutch government announced on Sunday that it had, as of September 30th, taken control of Chinese-owned computer chipmaker Nexperia, citing worries about the possible transfer of technology to Nexperia's Chinese parent company, Wingtech. Court documents showed the Dutch government's move came after months of rising U.S. pressure on the company. Nexperia was at risk of being impacted by a new U.S. rule that extends export control restrictions to companies at least 50% owned by one or more entities on the U.S. Entity List. Washington put Wingtech, which now has 100% ownership of Nexperia, on the U.S. list in late December. The Chinese Commerce Ministry, and they're the ones that control the licenses to export rare earths, issued on October 4th an export control notice prohibiting Nexperia China and its subcontractors from exporting specific finished components and subassemblies manufactured in China, according to a statement Nexperia published on Tuesday. And we have another headline: concerned car makers race to beat China's rare earths deadline. And this is Nick Carey and Christina Amon at Reuters. And this is from today, October 21st. Global automakers are scouring the globe for crucial rare earths ahead of looming Chinese export controls, with executives worried they could lead to part shortages and plant closures. While a U.S.-China deal diverted a supply threat, stockpiles were depleted by similar restrictions earlier this year, while Beijing has also made it harder to get export licenses. China has since dramatically expanded export curbs, with companies facing global supply shortages. Consultancy Alex Partners estimates China controls up to 70% of global rare earths mining, 85% of refining capacity, and about 90% of rare earths metal, alloy, and magnet production. The new Chinese export control list includes elements like ytterbium, holmium, and europium, also used in making cars, so they included new elements in their export controls. Quote, "The situation is very tense," said Nadine Rajner, CEO of German metal powder supplier NMD, adding customers want to source rare earths from anywhere but China. Rajner said that while there are plenty of rare earths available in countries like Sweden, they do not have the mines or refining capacity to make them usable. And for heavy rare earths, China controls 99.8% of global refining capacity, making alternative sources negligible. And this is the real bottleneck here. It's really the heavy rare earths where the rubber meets the road. This is the bottleneck. This is the issue. Hence, I would argue the agreement here between the United States and Australia. Quote, "We are pretty much sold out and have limited stocks," Rajner said. So quite a revelation. We are pretty much sold out. Rare earths can be recycled from old cars, but that industry is in its infancy. Neutral, a Renault-backed company, currently recycles rare earths from 400,000 cars a year in France and has contracts with 15 brands in Europe. But the challenge, quote, "is scaling up these activities," said Neutral CEO Jean-Philippe Bauwand. And this is what we keep hearing over and over, is you might be able to make some heavy rare earths in the lab, but the challenge is scaling it up. So here is another voice saying this. And then we have a quote from Ryan Grimm, Toyota Motors North American Group Vice President of Purchasing Supplier Development. Quote, "They can shut us down in 2 months, the entire auto industry." Bruno Guéry, President for France, Benelux, West, and South Europe at supplier Bosch, said he expected the auto industry to, quote, "overstock rare earths ahead of the deadline." But an executive at a magnet supplier for Hyundai said that while it built inventories earlier this year, quote, "most have already been depleted, and supplies are tight." Another big reveal. Some Chinese rare earth exporters received a rush of orders from overseas clients immediately after new export controls were announced on October 9th, 3 industry sources told Reuters. So this continues to be a major contender for the biggest story of the year, this rare earth issue and its implications. And so rare earth stocks have had quite a year as well. We have a story from CNBC also yesterday, October 20th. Rare earths make gains amid battle to beat China's dominance. And I took a look at MP Materials. What a year it has had. Year to date, up 431%. So a 5x on MP Materials had you held on January 1st. It really reminds me of the rare earth bull market from 2010, which is really where I started in this industry. It was 5x's, 7x's. So perhaps an interesting point of history to look at here. And another related headline, also from CNBC, Cleveland Cliffs shares jump more than 20% as steelmaker looks into rare earth mining. So anything with rare earths is starting to jump. And then if we go over to Korea Zinc, we had a very interesting story from UPI. Korea Zinc to start critical material gallium production in 2028. So it just goes to show how long it's going to take. Now, turning over to copper. We've seen the precious metals have a huge year so far. Of course, gold seemingly daily hitting new records, definitely weekly. And the records seem to be growing in size. It was about $100 a week. Now it's about $150 a week. And I have a wonderful discussion this episode with Jeffrey Christian of CPM Group on what is happening in the gold market and where we are, how it compares to 1979, 1980, and whether gold is still a buy. And Jeff's view on that with all of the run-up we've seen. So a wonderful interview coming up this episode. And we have some stories coming up as well. However, the copper story is increasingly feeling like an urgent one. Robert Friedland has been making a lot of statements recently on his concern in the copper market, on copper supply. And we have this story. This is from a staff writer at mining.com. Robert Friedland says global economy faces copper crisis. Global demand for copper is accelerating towards levels that could outstrip supply within 2 decades, creating what industry veteran Robert Friedland calls a once-in-history challenge for the world economy. Over the next 18 years, he warns, humanity will need to mine as much copper as it has over the past 10,000 years combined to sustain even modest economic growth. Friedland's message, repeated over years of public appearances, has proven prescient. Quote, "This is the revenge of the old economy," he said in 2021. Quote, "For 2 decades, not enough capital has gone into finding the metals we need for the energy transformation. Copper, he argues, lies at the center of both economic growth and national security. Used in everything from electric grids to military hardware, it has become the lifeblood of modern industry. As of October 2025, copper trades at over $5 per pound, marking a 55% increase from just 5 years ago. Despite the rally, current prices remain far below what the industry needs to stimulate new production. And so it's going to be interesting. I mean, right now, it seems like Western governments are more about putting the fire out on critical minerals and rare earths, and you can't blame them. They have a major issue, so it is understandable. But they have further fires to go here, and interestingly, it sounds like copper could be one of the biggest fires of all. Copper's importance extends far beyond economics. Friedland highlights its strategic role in national defense, pointing to U.S. military concerns over shortages of 155mm howitzer shells. Quote, "If someone's pointing a gun at you, you need that copper to shoot back," he said earlier this year. Friedland credits recent U.S. administrations, particularly under current President Donald Trump, for recognizing the need to secure raw materials domestically. Quote, "Speaking as a miner, we see a lot of government support. The new administration is correctly focused on making sure the world's largest economy has stable access to raw materials at the scale of that economy." Friedland describes the situation as a, quote, "powder keg ready to explode," adding that copper demand is, quote, "essentially infinite because there is no rational price for something you absolutely must have." So Robert Friedland sending out massive warnings on the copper market. Another interesting headline, this is the Financial Times. Trump tariffs hand surprise win to LME over New York rival. Copper trading has shifted from COMEX as uncertainty persists over U.S. president's trade policy. So that is an interesting development. Another headline, also from the Financial Times, BHP considers reopening defunct U.S. copper mines in response to Trump. And another headline, Japan, Spain, South Korea warn over unsustainable copper processing fees. And that is a headline from Yuka Obayashi at Reuters. And here just a couple of lines. Japan, Spain, and South Korea issued a rare joint statement on Wednesday, expressing deep concerns over tumbling copper treatment and refining charges, warning both smelters and miners cannot develop sustainably under current conditions. Copper smelters worldwide are grappling with falling processing fees and shrinking margins amid tight concentrate supply and expanding smelting capacity in China. In June, some Chinese smelters agreed to process copper for Chilean miner Antofagasta at no charge. The three countries' industry ministries said after an online meeting, quote, "We are deeply concerned that this deterioration in treatment and refining charges is prompting a reassessment of copper smelting operations worldwide, with several companies already indicating intentions to scale down or withdraw from copper concentrate smelting." So coming up on this week's show, we have Jeffrey Christian, managing partner of CPM Group, on gold, where we are in this cycle, and whether gold is still a buy, and his thoughts on copper. And also coming up on this week's Spotlight, we have Rob King, Executive Vice President in North America of Sequent, who discusses an industry in transformation. If you want to find us online, you can find us at northernminer.com. You can find us on X at Northern Miner. You can find us on Instagram at The Northern Miner, and on Facebook, LinkedIn, and YouTube, where we also host these podcasts and wherever podcasts are available, including Spotify, SoundCloud, and Apple Podcasts. And with that, let's turn to Rob King, Executive Vice President North America at Sequent, for this week's Spotlight. Joining us today for this week's Spotlight, I'm pleased to welcome to the show Rob King, Executive Vice President North America at Sequent. Rob, welcome to the show.
Well, thank you very much. I'm glad to be here. I've been a huge fan of the Northern Miner for a long time, and I worked closely with Northern Miner in my past. I'm thrilled to be here. And just for the audience who may or may not know who Sequent is, Sequent is a geoscience-first technology company that really helps geoscientists do modeling from early discovery and exploration. But we also are well known for our Leapfrog brand. But we're also heavily involved around infrastructure and civil engineering, as well as water management and environmental. And our focus is really everything that's kind of unknown below the subsurface. We're owned by a parent company called Bentley Systems, which is about infrastructure and digital twins above the surface, but we are below the surface. And right now it's at an all-time high in terms of the speed and actually of requirements to understand what is below that subsurface in terms of geoscience modeling. I'm based in Vancouver, Canada. And my responsibility is around managing the businesses and making sure our customers are productive across Canada, the United States, as well as Mexico.
Okay, excellent. Yeah, we've had Sequent on the show before, and it seems like Sequent is up to all sorts of cutting edge endeavors in the mining business. Rob, what are the big trends you're seeing this year? I mean, it is an industry in transformation with all of the technological developments. Sometimes people say that the mining industry is backward looking and slow when it comes to technology, but this seems increasingly to not be the case. What are the big changes you're starting to see or big trends you're starting to see in the industry?
Well, it's interesting is that you're right that maybe a traditional industry in the past is now leading an artificial intelligence future. And let's face it, it's headlines every day now, and it's changing every day in terms of what's going on around rare earth or critical minerals. And I honestly believe it. We're at an unprecedented time. It's almost like an industrial revolution that we're seeing here, kind of a once in 100-year situation. And it all ladders up to artificial intelligence and the data centers. And they've also become their own economy in many ways. And it's incredible the investment and attention that these AI data centers are taking. It's interesting, just JP Morgan, just in the last 3 or 4 business days, their market and wealth division came up with a research that of the S&P top 100, AI and data centers are generating 75% of the returns of the S&P top 100, 80% of the earnings growth of the S&P top 100, and 90% of the spending growth. And to summarize it all, we're watching even last week with our Prime Minister of Canada meeting with Donald Trump. It's clear U.S. wants to win the AI race, period. They want to win this race. And if you look at something like that Stargate project they had with OpenAI and Oracle and SoftBank, that alone has 40 years of critical mineral mining requirements. And then you look at Canada, it's trying to, maybe regain or secure itself as an energy and mineral superpower. And at the end of the day, there's billions, you could probably argue trillions of dollars on the table right now, building these 1,000-acre factories, if you will. And these factories are building probably the most valuable resource in the world, and that's intelligence. And mining is right there.
Indeed, as you mentioned, I mean, this has become a major, I guess, bullish factor, say, for copper and for critical minerals in general, rare earths, and you can go down the list. So how does Sequent then factor into helping that occur? Is it through the software component?
Yes, it is. It's through the software component for sure. And before I get into kind of what we do around speed and accuracy and as well artificial intelligence to make better decision making, in preparation for our chat today, even in the last 4 business days, this is what's happening. Like, we already knew that we had 18 mines fast tracked in Canada, 10 mines fast tracked in the United States. Just last week, the U.S. bought stake in Trilogy Mines. The U.S. administration with the Department of Energy invested in Lithium Americas. We've seen all these big hyperscaler, big tech companies looking for nuclear power and so on. Even the first U.S. rare earth mine in 70 years got a 5-year land permit. This is all in the last 5 days. The pace of what's happening here is demanding for our customers to go with speed and even more accuracy because the table stakes are higher than ever. And so for us, what we do is we're taking, particularly around our brand new launch Evo platform, which is a data management in the cloud platform. It's going to allow customers to take their data from all over the world, from all applications, not just Sequent applications, but their own internal, even competitor ones or other applications, and amalgamate it all and start making really fast decisions with accuracy. And it's going to have things like AI and machine learning here, as well as products like our Sequent Driver, which is like a rapid analysis tool. It automates exploratory data and modeling, and it allows them to go faster than the old way. And a lot of our users are using these new technologies going, I'm never going back the old manual way. This is so much better, so much faster. And so the theme today is pure market presence, market requirements, but we are moving real fast. And it's almost a bit of a, no pun intended, land grab to meet market demands of these AI data centers.
Interesting. And in terms of the kinds of companies that use this, is this more large scale miners or can it scale out? How does it work across different size companies?
For sure. So we are and have always been proud of the fact that 8 of the 10 biggest mining companies are customers of ours, but it does scale. And so when you have projects like the ones we were speaking to, all of a sudden speed up, the cloud and the Evo platform will allow you to scale up and take on loads of data with no issue. But also if things slow down a little bit, you can contract a bit. And what we are finding is that our customers, I get to go and meet some of our biggest global customers. They want this interoperability, or if you will, across platforms. They want to merge all these data points because they get nervous. Is the data up to date? Who's using it? Is it secure? Is it enterprise safe? They want it all merged together. And they're coming to us saying, sure, we love your technology. We'll start using your technology. And we've had a lot of the largest firms been testing and learning before we launched Evo, but they want to build partnerships with us now. Maybe perhaps as a classic vendor relationship with technology, but now we're looking at specific bespoke relationships, contracts, if you will, with these big global companies based around things like consumption. And the more you use, the more they'll spend, but they want to make sure that they have the latest technology across the board. So power users who are doing a lot of this the geoscience work for the projects we mentioned around, especially this resurgence, they want to have them the full suite of technology, the absolute latest with zero disruptions and zero inability to scale. But also I've noticed too, is that they want the technology available to all applicable employees. So before you may get licenses, now it's like we want everybody to have the technology. Power users get much, much more, and we're happy to invest in them. But even some cases, we have even like free models just for people who want to go in there and have a quick look at a model. They want zero blockers to technology, access to the technology, and they want to use technology to take advantage of the speed and market around what's going on right now with these data centers. So it's been a real change. And to kind of close it out is that right now we've been focused on the big global mining firms, but absolutely our platform scales across the board. So whether you're a consultant, whether you're a mid-market or you're for exploration, our traditional, if you will, technology, Leapfrog Geo, but also upcoming up with Evo, applies to all. And we're pleased with the fact that we have thousands of customers in North America that range from very small one-person shops up to the Barracks and the Techs and the Newmonts.
Okay, excellent. So this works across the board here for many people across the industry. And in terms of AI, of course, AI is the big revolution going on in the last couple of years here in the world in general, but it's also transforming the mining industry. How is AI transforming the mining sector from your perspective?
From my perspective, how it's transforming is that, when you look at the requirements of managing your plethora of data, it's getting all the data to work better together and using AI to help create thousands of algorithms and thousands of models and geomodeling that used to be done manually in a very tedious process. And so now what we find is that it's going to allow them to connect all their modeling tools, all their applications, but also across the workflow. And so you start to think about a fast track mine. As we know, it could take up to 20 years. And traditionally to do a mine, there's an encouragement here to speed that up to much, much less. So they can go from early discovery, carry the data and the modeling into exploratory, carry it into early design and build of a potential mine site, all the way into production. And they want that kind of end-to-end supply chain, if you will, to make sure that it's running and it's optimized and everyone's looking at the same geo models. But also think about the investment angle too. We have so much investment circling around this opportunity that even more so they can prove what's in the ground, what's coming out, how fast, how often. And it's interesting, just on that note too, even just yesterday, JP Morgan, as I mentioned earlier, they also announced a $1.5 trillion fund around, I think they're putting in 10 billion themselves over the next 10 years, a fund around US supply management and making sure that it's just optimized and it's secure. And it's again about this US wanting to win the AI data race. And it starts with critical minerals. And so money's on the table. We need to make sure that end to end from discovery to production is well monitored, well managed, and secure within platforms of data management.
You do get that impression that the United States is now firing on all cylinders, so to speak, in order to truly compete with China on AI. And so as we wrap up here, Rob, what do you want people to take away from this conversation here? In a sense, what is your message to people in the industry who are listening to this conversation? What do you want them to know?
I want everyone to know that this is an unprecedented time that we need to capture, but as always, with geoscience first as the mindset and always integrity without compromise. And as we look at this race to win the AI race, and we're building these 1,000-acre factories, the most recent Meta data center is 70 football fields. It's a $10 billion investment. 70 football fields. You can't even imagine that. But let's not be intimidated by this thing. Let's embrace it. And let's think about how can we actually now help the mining industry manage this opportunity properly by using smart technology, by using the AI that these data centers are outputting, using AI to put into classic geoscience modeling to understand where these minerals are going to come from and when, and what's the timeline look like? Because we are taking a timeline and expediting into building these things right now. In addition, we have to take a look at the data centers themselves and think about the ramifications around that. We have to build the actual building. Obviously, the technology that goes inside it is mass critical mineral focused, but then also other components around Sequent around, is there enough water to cool? I think I recently read that a major data center, you can take up to 5 billion gallons of water daily to keep it cooled. Is there a way to keep an energy flowing into it? Is there enough energy? And the odds are it's probably going to be very sustainable energy because the big hyper-tech companies need to be sustainable for their shareholders. So is it geothermal? Is it nuclear? And the answer is yes. So the takeaway is I want everyone to realize that this is not intimidating. This is actually an incredible opportunity for the industry. And it's an incredible opportunity for Sequent as we launch our Evo data management AI platform. We're here and we'd love to partner with our best customers or new customers.
How should people contact Sequent? Is it just the website, sequent.com?
By all means, go to sequent.com. I'd be happy to share my contact information after this podcast and have it available to you. But simply go to sequent.com and click on Contact Us. And there's lots of ways on the website, as well as lots of case studies too. If you just go even on the homepage and just scroll down a little bit, there's some amazing real-time case studies, all relevant to what we just talked about over the last 10, 15 minutes.
Rob King, Executive Vice President, North America at Sequent. Thank you for joining us and sharing everything that's going on at the company.
And thank you, Adrian. It's been a great start to the week.
Thank you once again to Sequent for sponsoring this week's episode of the Northern Miner Podcast. If you want to learn more, visit sequent.com. Turning to the website, gold price soars to record ahead of U.S.-China talks, rate cut decision. Gold set a new record on Monday, rebounding from Friday's drop as uncertainty over U.S.-China trade talks, as well as expectations of a Federal Reserve rate cut, fueled demand for the safe haven metal. Spot gold rose as much as 2.9% to $4,380.89 an ounce, surpassing its all-time high from last week before the sell-off. U.S. gold futures jumped over 4% to nearly $4,400 an ounce, also a new high. Prices are now up more than 65% so far in 2025, underpinned by soaring demand for havens in the face of geopolitical and trade tensions, rising fiscal and debt levels, and threats to the Federal Reserve's independence. So we discuss this in depth with Jeffrey Christian on this week's episode. Continuing on, HSBC expects gold bull wave to hit $5,000 in 2026. This is Reuters via mining.com. HSBC on Friday forecast that gold's bull rally would drive prices as high as $5,000 an ounce in 2026, supported by elevated risk and the impacts of new entrants in the market. Quote, "The bull market is likely to continue to press prices higher, and we could very well reach a high of $5,000 an ounce sometime in the first half of 2026. Unlike previous rallies, we believe many of the new buyers are likely to stay in the gold space, even after the rally ends. Not so much for appreciation necessarily, as for gold's diversification and safe haven qualities." And another gold story, gold now a momentum meme asset, says Bond Veteran. It's by a staff writer at mining.com. In a post on X last Friday, PIMCO co-founder Bill Gross wrote that gold has become a momentum meme asset. Quote, "If you want to own it, wait a while." He added, even if gold's safe haven appeal has never been stronger. Continuing on, of course, the silver market is also at records. Royal Mint warns of delivery delays as Londoners rush for silver. This is Bloomberg News via mining.com. London's demand for precious metals has pushed the Royal Mint into overdrive. A rush of orders from retail investors has prompted a ramp-up in output, but the 1,100-year-old institution is warning of possible delays in silver deliveries as it races to replenish its reserves. A global surge in demand for precious metals has boosted silver prices by more than 80% in London's wholesale market this year, with a fresh wave of orders from banks and other institutional buyers culminating in a historic squeeze this week. Inventories in London's vaults are critically low, and fresh stock is being flown in from as far as New York. Buyers have been flooding into London's street-level bullion outlets too, with voracious demand for small bars and coins, prompting the Royal Mint to run its presses harder. Still, the institution is warning buyers of possible delays in silver deliveries. You know, when you read stories like that, it's starting to sound like a bit of a mania. So what will the mania look like at $100 silver? if it's already this intense. Continuing on, shifting gears, Canada signals approval of U.S. government stakes in mining firms. This is Bloomberg News via mining.com. Canada is unlikely to object to U.S. government investments in two Vancouver-based mining companies, Energy Minister Tim Hodgson said, describing the deals as, quote, capitalism in action. The Trump administration announced last week that it would take a 10% stake in Trilogy Metals as part of a $35.6 million investment to boost critical mineral projects in Alaska. It's an interesting question, actually. If a government takes a stake in a company, is it capitalism in action? The U.S. also agreed to acquire an interest in Lithium Americas, which is developing the Thacker Pass lithium project in Nevada. The federal government has rules under the Investment Canada Act for acquisitions by state-owned entities, and Canada's industry minister said the government will evaluate deals on a case-by-case basis. But Hodgson said Thursday the U.S. stakes are, quote, small minority investments in firms with U.S. projects. Quote, the fact that an ally of ours chooses to make an equity investment into a Canadian company whose sole asset is in the United States, I don't think that bothers us at this time. He said at a news conference in London where he was promoting critical minerals and energy deals. I think that's capitalism in action. If they're interested in doing that, that's up to them. Continuing on, Canada threatens Stellantis with legal action over plan to shift output to U.S. This is Reuters via mining.com. Canada threatened legal action against automaker Stellantis NV on Wednesday over what Ottawa says is the company's unacceptable plan to shift production of one model to a U.S. plant. Stellantis announced a $13 billion investment in the U.S. on Tuesday, a move it said would bring 5 new models to the market. As part of the plan, production of the Jeep Compass will move to Illinois from a facility in Brampton in the Canadian province of Ontario. Industry Minister Melanie Joly sent a letter to Stellantis CEO Antonio Filosa, noting that the company has agreed to maintain its Canadian presence in exchange for substantial financial support. Quote, anything short of fulfilling that commitment will be considered a default under our agreement. She said, if Stellantis did not live up to its commitment, Canada would, quote, exercise all options, including legal, she said. A copy of the letter was made available to Reuters. The existence of the letter was first reported by Bloomberg. Continuing on, we have a story from the Northern Miner. New Ontario rules aim to speed up mine approvals. And this is by Frederick Temesco. Ontario has introduced rules designed to cut mine approval times by half, a move that Energy and Mines Minister Stephen Lecce insisted will make the province more competitive in the global race to extract critical minerals. Dubbed One Project, One Process, the framework creates a centralized permitting and authorization model that aims to approve advanced exploration and mine development projects in a maximum of 2 years, Lecce said Friday. The reform will give investors and developers the confidence to build mines and create jobs across northern Ontario, he said. How much changes in just a few years here? Quote, the imposition of a maximum 24 months to approve a mine in this province is now the law of the land. This is fundamental to transforming Ontario as a true energy superpower, Lecce said during a news conference at the Toronto Stock Exchange. Quote, economic self-reliance starts with our ability to move resource projects forward. Mines will be our anchor to keep Canadians employed. Fascinating story from Frederick Temesco. Continuing on, critical minerals firms boost Washington lobbying as U.S. expands investments. This is Reuters via mining.com. So lobbying is increasing as the U.S. government gets increasingly involved with equity stakes in mining companies. And also, United States Antimony offers $470 million to buy Australian miner. This is by a staff writer at mining.com. United States Antimony Corporation is planning to acquire Australia's Larvotto Resources, a move that it says would make the combined company one of the world's largest antimony producers outside China. Continuing on the traceability of these resources, MineSpider Rare Earth Ventures partnered to bring traceability to Australian minerals supply chain. That's by a staff writer at mining.com. Nathan Williams, founder and CEO of MineSpider, said in a press release, quote, traceability and transparency are no longer optional. They're the foundation for gaining market access and investment. Through our partnership with Rare Earth Ventures, we're helping Australian mines prove their ESG performance and unlock global opportunities. And we also heard from Teresa Schmidt, director at Rare Earth Ventures. Quote, at REV, we see traceability as fundamental to building investor confidence in critical mineral supply chains. Partnering exclusively with MineSpider allows us to deliver secure, transparent, and ESG-aligned solutions to our clients worldwide. And another story on traceability, this is by Cecilia Jamasmy at mining.com. Amaroq begins selling traceable gold from Greenland. Amaroq Minerals has kicked off sales of fully traceable gold from its Nalunaq mine in Greenland through the Single Mine Origin platform, marking a milestone in the country's responsible mining efforts. The company said the SMO-certified gold provides buyers with complete transparency, ensuring that each bar is responsibly mined and mercury-free. Those are your news stories. Now, let's take a look at metal prices. And turning to metal prices, let's take a quick look at the bond market for context. The U.S. 10-year bond is yielding 3.97%. That is down 0.05%. The UK 10-year gilt is yielding 4.5%. That is down 0.11% on the week. The Italy 10-year bond is yielding 3.36%. That is down 0.08% on the week. France's 10-year bond is yielding 3.36%. That is down 0.07% on the week. The German 10-year Bund is yielding 2.57%. That is down 0.03% on the week. The Japanese 10-year bond is yielding 1.66%. That is unchanged on the week. And China's 10-year bond is yielding 1.77%. That is up 0.01% on the week. Turning to precious metals, gold is trading at $4,272.70 per ounce. That is $120 higher than last week. Silver is trading at $48.64 per ounce. That is $2.23 lower than last week. Platinum is trading at $1,638 even. That is down $24 on the week. Palladium is trading at $1,516 even. That is up $15 on the week. Turning to industrial metals, copper is trading at $5 even per pound. That is 8 cents lower than last week. Iron ore is trading at $105.35 per metric ton. That is 39 cents lower than last week. Aluminum is unchanged at $1.26 per pound. Lead is also unchanged at 90 cents per pound. Nickel is still below $7 at $6.91 per pound. That is 3 cents higher than last week. Tin is back below $16 at $15.89 per pound. That is 52 cents lower than last week. Cobalt is higher at $19.38 per pound. That is 39 cents higher than last week. So cobalt continuing to climb. Lithium is trading at $10.39 per kilogram. That is 14 cents higher than last week. Uranium is unchanged at $78 per pound. And zinc edges lower at $1.35 per pound. That is 2 cents lower than last week. Zooming out, precious metals showing some volatility, up and down, breaking records, pulling back sharply, while industrial metals continue to trend sideways with wins in their sail, with cobalt being the standout, just below $20 at $19.38 per pound. It wasn't that long ago we were below $10. So the export controls out of the Congo are having their effect, and those are your metal prices. Coming up, I'm very pleased to welcome back to the Northern Miner podcast, Jeffrey Christian, managing partner at CPM Group. We discuss the big, roaring, historic bull market in gold and what it all means and Jeffrey's latest insights on what is happening, as well as how it relates to previous bull markets, particularly the big peak in 1979, 1980. Is it too late to buy? Hope you enjoy the conversation, and I will see you on the other side. Joining us today, I'm very pleased to welcome back to the Northern Miner podcast, Jeffrey Christian, managing partner of CPM Group. Jeff, welcome to the show.
It's always great to talk to you, Adrian.
And it is wonderful to talk to you, Jeff. Thank you for making time in what must be a busy schedule these days. I looked at my CNBC here right before we started. Gold up 2.78%, $4,329 on the COMEX CNBC futures. Are you busy? How are things?
We are very busy. This is perhaps the busiest time in my career, which is 50 years now. It's incredibly busy. And because our clientele are international, it's almost 24/7.
Incredible. And have you seen anything quite like this in your career in terms of the price? I mean, I feel like we're seeing new records here, in a pretty regular way. I mean, this is probably something that hasn't really happened in this way since the late 70s, I'm assuming. I mean, have you seen anything like this in your career?
Well, I was going to say, 1979 into early 1980, there are some strong similarities, although there's some very important differences. And then really the period from, say, 2000, 2001 into 2011. And that was a much slower burn in a way, although, to some extent, our analysis is that what's been happening since 2019 and what's been happening really in the last couple years or so far this year is a continuation of a long multi-decade deterioration of economic and political stability.
That's basically where I wanted to go next. I mean, when you kind of strip away all of the surface reasons, is that really why the price of gold is going up?
Yes. And it's a fascinating time because if you look at it, there's so many factors that are coming into play. We look at our gold analysis and any commodity analysis, and we talk about blending our macroeconomic top-down view of the world with our microeconomic view of supply and demand and investment demand and central bank demand, and inventories, and you blend those two together. And then you come up with a view, and then there's shorter term things that don't necessarily show up in the supply demand data, market conditions that you pay attention to. And then once you have a view as to where the market's going, you look at technical analysis, which tells you about the pacing. So I have a view that the price of gold is going to rise or fall. What's a realistic pace at which to expect that? Because a lot of times what you hear is, gold's going to $5,000 tomorrow. And it's like, well, it could go to $5,000, but it's going to take years to do. So that's the one thing. The second thing is, in November of 2000, a week after George W. Bush was elected, and there is a real reason for pointing that out, we issued our 2000 year gold yearbook. And in the speech to launch that, we said, look, for 20 years, people have said, do you think that we could see gold spike to $850 the way it did in 1979, 1980? And my response for 20 years was, if you can convince me that we could see 14% inflation, 20% unemployment, 21% interest rates, a quadrupling of oil prices, American hostages in Iran, Soviet troops in Afghanistan, if you can convince me that we're going to see as hostile an economic and political environment as we had in 1979, 1980, I will grant you $850. I said, but here in November 2000, I'm going to tell you that there's an upward shift in the investment demand curve. More investors will be buying more gold at higher prices for a longer time. And if you look at the period from the 1960s till 2000, you would see 1 or 2 years where economics would get bad. People would buy more gold. The price of gold would go up. things would get better, people would buy less gold, and the price of gold would go down. And we were saying in 2000 that there was a gold renaissance that was going to start with private investors and then spread to central banks, and it would last decades. And it was predicated on the view that going forward for the next several decades from 2000, you would see an increasingly more hostile economic and political environment globally, as well as nationally and regionally. And that's exactly what we've been seeing. Yeah. So we had this slow burn from 2000, 2001 to 2011. It came down, it gestated, and then in 2019 it started rising again. And then, again, this year we saw a sharp increase in the early part of the year. We saw prices kind of move sideways from May until September, and then they've risen very sharply in September again. And the basis is not any one thing, it's a combination of dozens of economic and political problems.
Indeed. I mean, every gold record article I see, I feel like I have a new reason. If you could go more granular, I mean, can you go more granular? I mean, can you determine the main factors that are driving this move in the price of gold?
Well, there's several factors. And, yeah, I can go granular and we can spend the next 5 days talking about all of the things happening. At the end of the day, you start with the price of gold rising and you say, why is the gold price rising? And the answer is because investors around the world are buying more gold and have decreased their price sensitivity. And then you say, well, why are investors buying gold? And it's like, well, concern about the currencies, concern about the excess amount of debt in the world. People focus on the U.S. Treasury's debt, but in reality, the U.S. Treasury's debt is the more secure debt. And if you look at the U.S. Treasury debt relative to percentage of U.S. GDP, and then you compare that to total debt in the world compared to as a percent of world GDP, the whole world is in much worse shape than the U.S. Treasury, and it has a worse credit rating than the U.S. Treasury. By and large, there are very few countries that now have credit ratings that rival that of the U.S. Treasury. So you have this enormous debt. You have the origin of sovereign debt, which is perennial and persistent and growing deficit spending on the part of governments around the world. Then you have the growth of private debt around the world and a slowdown in overall economic activity. You have the tariffs, and the tariffs, as bad as they are, and they are bad for global economic growth, the tariffs are a symptom of a broader reduction in global trade that we've been seeing for several years. And so you have reduced global trade, reduced global growth, maturing economies, maturing populations. I mentioned November 2000. I'll just say one thing. Prior to the 2000 election, Dick Cheney was president, CEO, and chairman of Halliburton Oil Service Company. And he gave a speech like in 1998 or so, 1999, at the Royal Academy of Petroleum in England. And he said, look, there are two big prizes in the hydrocarbon world. The first one are hydrocarbons in the Islamic states, which are basically controlled by state oil companies and gas companies, and they don't want to do business with Western companies. So we have to wrest control of Islamic State oil and gas assets from the governments. And the big prize, he said, was the hydrocarbon assets in the former Soviet Union republics. And that stuff has been privatized, but there's an impulse to renationalize it. And we have to fight that. So he gave that speech and he sort of said, this is what we're going to do. At the same time, his guy who became the Bush's foreign policy advisor, Paul Wolfowitz, wrote an article in a magazine saying the next administration is going to have to overthrow Saddam Hussein under any pretense. And then you had the neocons, including Wolfowitz, saying, we've made a mistake. We have been trying to be allies and partners with the People's Republic of China, And we should see them as competition, not as a government and a country that is going to become a capitalist partner with us, but rather a managed economy that will be our chief competitor. So you saw these guys sort of saying, this is what we're going to do to justify attacking Middle Eastern countries, including Iraq. And this is what we're going to do to try to bastardize the Russian economy, which was at the time, 9 years into independence. And this is what we're going to do in terms of our relationship with China. They told everybody what we were going to do. And that started 2000, 2001, and it's just continued and gotten worse and worse. So this is a long-term, multi-decade decline in global political cooperation, internationalism, globalization, economic development, and economic problems. So it's not like anybody should be surprised.
I mean, one of the more interesting theories I've heard for the metals going up recently is that China is wresting control of the price of the market, of the precious metals markets, particularly gold, that they have more control over the price now, and therefore it's being liberated, kind of a bit of a gold bug theory, from its, previous, repressions, so to speak. What do you have to say about that?
Well, first off, I would say that the gold price didn't need liberating. If there was a conspiracy or an effort to suppress the gold price, it was by complete incompetence. When I gave that speech in November of 2000, the gold price was around $270 an ounce. Now it's 4,300 some odd dollars an ounce. So if somebody was trying to repress or suppress the gold price, they really failed miserably over the last quarter century. But that said, I also think even as globalization has run into problems, there's been a globalized development. And it's not just China, but it's also Indonesia, Malaysia, India, and other countries that have actually grown in importance. And, if you go back maybe 10 years ago, CPM Group had as its clients many of the companies that then belonged to the World Gold Council. And they would ask our views of the World Gold Council and our advice as to what the World Gold Council should do. And we said, well, they should hire a CEO who actually knows about gold and cares about gold, because generally speaking, they have people who are just sort of like British gentlemen who don't necessarily care about gold. And the guy who was in charge back then seemed to have great disdain for gold as well as for gold miners. But one of the points that we made was that you would see growing importance of China, and at some point there'd probably be a shift to the point where Shanghai was having more influence on gold price formation than London or New York. It wasn't an anti-London thing, it was New York and London. And I should point out that it does, but a lot of the trades actually still occur in London and New York, but they're Chinese trades. And there are some very large Chinese participants very active in both the London market and the New York market. But we were suggesting that the World Gold Council at some point probably wanted to relocate its headquarters to Shanghai, which did not go over well at all with anybody who was working at the World Gold Council. But, the executives at the mining companies that own the World Gold Council understood what we were talking about. So that didn't really ingratiate us with the World Gold Council. But hey, I've had worse enemies.
I'm sure you have. So, in a sense, then, to almost rephrase it, so we could say, though, according to what I understand from what you're saying, that China does have more influence over the price of gold right now, in the sense that it's a bigger market. So it just has more influence, shall we say, in the market for what that's worth. Make of it what we will.
China's the largest mining country, gold mining country. It's probably the largest refiner of gold scrap. It's first or second in terms of gold fabrication demand and investment demand. And its rival is India, not any place else. London is an entrepot. It's a trading center, but it's not a producer or user or a net investor of gold. And the United States is not a major user It is a producer. It's a significant producer, but it's not nearly as big of a producer as China. So, it's a natural thing. Now, there's this meme that you hear over and over again that all of the gold in the West is being moved to the East. And that's nonsense. If you look at net gold acquisition for investment purposes, in China over the last, say, 17 years, it's been about 50 million ounces, 60 million ounces. In Switzerland, it's been like 160 million ounces. It's like 3 times as much. So there's still a tremendous amount of gold in New York and North America and Europe and Switzerland, in the UK, in Germany, in France. There's more gold in India than before, and there's more gold in India probably than in China or any other country. But China is clearly much more important. India is much more important. As I said, Malaysia and Indonesia and other countries are very important as places where people buy gold and either make it into jewelry or electronics, or they buy gold and they hold it as gold investments. And it's not just like, with Malaysia, we were talking to the government maybe a decade ago, and we were showing them data about how much gold is held by investors in Malaysia. And they said, who and where, who owns this gold and where is it stored? And it's basically stored in private vaults. And part of it's Malaysian investors, but there's a tremendous interest in storing gold in Malaysia on the part of Islamic investors elsewhere. They don't necessarily want to have their gold or all of their gold in their home country because of potential for political instability and confiscation. They don't necessarily trust the United States, the United Kingdom, Switzerland, or other industrial countries. They've seen sanctions. There's this nonsense about, the U.S. is weaponizing the dollar with its sanctions. We put sanctions on countries in the 70s. This is nothing new. And Europe and Japan went along with us. So there is a shift in where the gold is being bought, who owns it, and where it's being stored. But there's still an enormous amount in Europe and in North America.
I mean, another thing we're hearing, you describe all these different countries like India, having more gold, and perhaps Malaysia. We hear about the BRICS. There's a general sense out there that there's a bit of an anti-dollar trade going on, a debasement trade, so to speak, that, the dollar's going down, so you need to get into real assets. And so people are piling into gold. What do you make of that?
There is a desire to see a reduction in the amount or the percentage of world wealth held in dollars. And that has been the case for almost half a century. And there's a tremendous headwind in that the dollar has such a large portion of global wealth, both central bank wealth and private wealth, that it's very hard for any other currency to become a competitive denominator. If you look at it on a foreign central bank basis, the dollar is still like 57, 60% of foreign exchange holdings by central banks. And that's up sharply from where it was in the 70s and 80s, but it's basically in line where it's been since the beginning of the 90s. So central banks own more dollars today than they did 10 years ago. The central bank dollars that are being spent mostly are coming in on a monthly basis or a continual basis through trade and capital settlements. And they'll use those dollars to buy other currencies or gold. And the base capital holdings of dollars tend to stay the same. Now, China did sell several $100 billion worth of dollars, but it wasn't a debasement trade. It wasn't an anti-dollar trade. It was an effort to try to boost economic activity and stabilize the Chinese economy. In total, China spent about $1 trillion, I believe, of central bank reserves trying to help the Chinese economy. Since more than 60% of Chinese foreign exchange reserves were in the US dollar, it's only natural that they were selling a lot of dollars. to do that. It wasn't that they were saying, oh, the dollar's trash or we want to trash the dollar. It was they're saying, thank God I have dollars. Because if you look at it, the dollar, if you look at the Federal Reserve Bank trade weighted dollar, the dollar was trading around 85 in 2008 during the financial crisis, and it rose sharply during the financial crisis to about 105, and it came back down to about 108 or so, or 88 or so. And today it's down to 120 from a peak of 130 at the beginning of this year. So people will say, oh, well, my God, the dollar has lost 8% since the beginning of this year. Clearly people are dumping the dollar. And you say, yeah, that's true, but it's also still up like 14% from where it was at its 2021 low. And it's up like 60% from where it was in 2008, 2011, when the U.S. credit rating was downgraded for the first time. It's up like 60% from there. So people talk about the debasement trade, but the data, the reality of the dollar market doesn't support that. I often say the dollar's like your mother. You'll sit on the playground and you'll talk trash about how you hate your mother, but when you scrape your knees, you run to the dollar. Yeah. If you look at U.S. federal debt that's held overseas by foreign and international investors, it's at record levels. It's like $9.1 trillion of U.S. treasuries held offshore. Some of them are U.S. investors, pension funds, corporations, wealthy individuals, but a lot of it's foreigners. And that has been rising like at an 8 to 10 to 14% per annum rate over the last 6 years since 2019. So investors are still buying the dollar and they're still buying treasuries and they're buying gold and silver because the dollar and treasuries and gold and silver are the safe haven assets you run to when you have economic and political problems that are causing you to say, I should have more of my wealth in safe havens.
I've heard you in the past mention how investment demand is the main factor here, oftentimes in the gold price over time. And so we're at 4,300. We've seen what looks like almost a parabolic move because when I was measuring the gold price each week, it seemed like it was going up $100 a week. Now it seems like it's going up $150 a week, right? So I guess the question is this overbought? Is this a bubble? It seems to me this is a hard recommendation to make at these levels to start buying gold here.
It depends on who you're recommending, gold to. I mean, if you're a long-term investor, buying gold at today's price could make sense. If you're a short-term investor, it doesn't make sense. And last week we had the situation where we were seeing $100 moves in gold prices on a daily basis. And when the gold price got to like 4,400, we issued a short-term trade recommendation to sell. And the next day the price rose further and I felt like a fool. And then on Friday it fell sharply. And now today it's back up, So a short-term investor might not want to buy gold at these prices because the price has, as you said, it's not going parabolic, but it has the potential to. And to some extent, this looks like September, October of 1979. I tell the joke, I was a young guy, relatively new to the precious metals market in 1979. And I was having lunch with George Cleaver, who was Mr. Gold mining analyst at Merrill Lynch. He was the world's best rated gold mining analyst. And the gold price had gone from like $190 to $300 by September of 79. And he said, where do you think it's going to be in April? And I said, $500. And he said, you're crazy. It's not going to go $500. And in January, it was $850. And he called me up and said, you're crazy. He thought $500, it's $850. And in April of 1980, I called him up and I said, gold's $500. It's off, $350 from its January peak. And if you look at the move that we've seen in September and October of this year, it's similar in some ways to what we saw in September and October of 1979. Now, there are big differences, but some of the differences we've talked about. China is much more important. India is much more important. Both of those countries have much more And other Asian countries have much more sophisticated financial markets now than they did back then. And the political environment has deteriorated even further. The debt in 1979, the US government had less than $1 trillion of debt. It had a $58 billion deficit. And people were saying, we can't support a $58 billion annual deficit. We can't support $1 trillion of debt. Fast forward, 45 years, and you've got $37 trillion in debt and $2.7 trillion deficit. And people are saying we can't afford that. And they may be right this time, but they've been wrong for the last 45 years in continually saying this can't last. And it can't last, that's true, but it can last a long time. And it has lasted a long time. And I was a critic of $58 billion deficits and $1 trillion of debt in 1979. I didn't think it would collapse the US economy or the dollar, but I didn't like the idea of perennial debt and deficit spending. I've always been debt averse. So you've got a much worse situation now than you have. But it does look like, as I said, if I were a short-term investor, I probably would not be buying at $4,340. But if I were a long-term investor, I probably would be buying at prices above 4,000.
Now, one of the more interesting observations I've had here when talking to you over the last few interviews is this notion that central banks are opportune buyers and that they'll sell high and buy low when it comes to gold. But are you seeing a bit of a shift right now with central banks? Like, are you seeing them buy at elevated levels? It sounds like China is continuing to buy from what we see in the headlines. Have they changed their behavior?
They have changed their behavior. They are less price sensitive than they used to be. They are more willing. I mean, if you look at some central banks that we know, they were buying at 1,200, 1,300 in early 2019. When the price got over 1,350, they stopped buying. Some of these banks did not buy from 1,350 up to 2,000. But when the price went from 2,000 to 1,680 in November of 22, they started buying again. So central banks that said, oh, I'm a buyer at 1,200, but not over 1,350, had said, okay, the world's changed. The upward shift in the demand curve has occurred. The upward shift in prices has occurred. 1680, which is off 20% from where it was 8 months ago, looks cheap to me. And you've seen central banks scale up their expectations with the gold price. So central banks that were not buyers at 2,600 in January of this year probably would be buyers at 3,800 now. But if you look at the central banks in general, and yeah, China has bought about 680,000 ounces through August. Yeah, that's markedly lower than what they were buying in 2022, 2023. I mean, they bought about 2 million ounces in November and December of 2022, just in 2 months. In 8 months of this year, they bought 680,000 ounces. The number of central banks that have been buying has declined. It's somewhere between 12 and 20 central banks now. And the gross purchases have been about 6 million ounces, but there have been a couple central banks that have sold about 1.8 million ounces. So that on a net basis through August, central banks were buyers of about 8 million ounces. That suggests that for the full year, it could be about 6 million, 7 million, 8 million ounces. Now, that's kind of in line with what we saw last year. It was about 8.8 million ounces last year, but it's down from 14 million ounces 2 years ago. So there is a price sensitivity still, and central banks, unlike a lot of private investors, central banks will try not to chase the gold price higher. They'll wait for it to come back. Now, there's something else here. You keep hearing this, that central banks have been buying 30, 33 million ounces a year over the last 3 years, but they haven't been reporting it. Central banks used to be very secretive, but starting around 1999, there were a series of central bank interbank agreements, including the IMF and the BIS, whereby they said we are going to be much more transparent and we're going to be much more responsible about reporting things. And the People's Bank of China and other banks have joined those international agreements, and they've pretty much been responsible. And in 2014, 2016, 2015, the People's Bank of China said we're changing our foreign exchange and our gold policies. And we have a bunch of gold that we are holding in a trading account that other entities within China have given us to sell. And we're going to buy it and add it to our monetary reserves. And then going forward, we will continue to buy in the domestic Chinese market, and we will report what we're buying on a monthly basis as per the international agreements. So you get this situation where you say, okay, gold promoters, people who are paid to convince investors to buy gold, have been saying that central banks have been secretly buying 20 million ounces of gold more than they've been reporting over the last 3 years. And central banks are saying, no, we're living up to our international agreements. Yeah. And the IMF and World Bank had their annual meetings last week. And there was no discussion. Oh, are you guys secretly buying gold and not reporting? Have you stopped living up to your agreements? There was no discussion there about that, at least in public.
It seems to me the bigger story, in a sense, is it does seem like the significance of gold has changed, though, for central banks. In a sense, I'd argue it has become more important, seemingly. I mean, would you agree with that?
In 2015, when the Central Bank of People's Bank of China made that announcement, it was very interesting because they said, since the revolution in 1949, we have said that we thought that gold was a small and insignificant part of our monetary reserves. And going forward, we are thinking that gold will play a small but significant role in our monetary reserves. And that goes back to what we said in 2000, which was the gold renaissance, whereby first private investors would say, the world's changing in a way that makes me want to own more gold longer, and I'm willing to pay a higher price for it. And then central banks would join in too. And that's exactly what's happened. Central banks are probably more interested in gold, paying more attention to gold than they had for several years in that interregnum. I mean, in the through the 1980s and through most of the 1990s, you saw central banks being very secretive, but very active in managing their gold reserves, partly because you had a lot of central banks that had built up a lot of gold reserves during the dollar gold standard era, saying, okay, Americans are buying our goods and services. They're paying us in dollars. The U.S. government says that the dollar is worth $35 per ounce. Here's what your dollars, give me your gold. And, they basically, there's a run on U.S. Treasury gold on the part of central banks up until 1971, when that window closed, at which point the central bank said, okay, we have a problem. We have 80, 85, 90, 95% of our monetary reserves in gold. We now have a floating exchange rate market where investors decide the exchange rate on a continual basis in an open market. We need dollars to defend our currency when investors think that our currency should be falling. So we need to sell some of this gold so we have dollar reserves. And that's when you started to see the shift in the 70s and 80s, where central banks started selling their gold and replacing it with dollars because they needed those dollars to defend their currencies. That trend, if you think about it in really broad terms, you had the Depression and World War II. And after World War II, the victors set up an international regime, currency regime, financial regime, regulatory regime, political, everything was sort of set up for this internationalized world. The idea being that, if governments could come to the United Nations, they could avoid war. And frankly, we have had fewer wars since the creation of the United Nations. But you had this period after the war where the overriding trend globally was globalization. We're mankind, and we got to get together and we got to be better because with nuclear weapons, we could wipe this place out. And that trend continued. And part of it was, well, let's create a European central bank and let's create a centralized European monetary system. And they started talking about that in the 50s and 60s. And, it took until 1999 to create the euro and the European Central Bank. But in the late 80s and 90s, you started seeing the political impetus at a non-governmental level shift to decentralization of power. And you started seeing people say, let's not have ever bigger governments. Let's have more localized governments having more control. And that's happened in the United States. It's happened in virtually every other country. The Soviet Union doesn't exist anymore. There are 15 states, governments there. So you've seen that decentralization, and part of that decentralization spills over into the currency market, the international currency regime, and owning gold.
As we start to wrap up here, Jeff, just on the opportunities you're seeing, switching gears a bit. I mean, it seems to me we've seen the precious metals, gold, silver, platinum, and palladium do quite well in the last few months. But when I look at copper and you hear all the stories of the fundamentals, copper seems like it's still waiting to really take its turn. It is doing well, but I mean, when I look at $5 a pound, how are you feeling about copper?
Yeah, I think copper probably got up close to $6 like in the summer. And it did come off. And yeah, the tariff news had a lot to do with that. It's interesting because in London during the LME week, you had sharp divisions in the views toward copper. And some people are saying, oh, demand for copper in electrification and other applications is going to far outpace the supply of copper from mines, and the price is going to go sharply higher. And other people were saying, no, there's a lot of copper that can be mined. There's a lot of copper that is available in scrap, that it can be refined from scrap. And there are natural price resistances to using copper. I happen to think that the price of copper is likely to rise over the next 10 years. If we get into a recession in the next 2 or 3 years, that could obviously be a little bit negative. In the intermediate term, I'm a little bit hesitant to talk because we have been revising our long-term 10-year copper supply, demand, and price projections. And we're probably a couple weeks from being, probably 3 or 4 weeks away from having a definitive view. So right now we're picking up all these bits of information about mine production, about scrap availability, about fabrication demand, about inventories. We've been wrestling with our economic outlook, and we've changed our economic outlook from thinking that we had been saying for some time we thought there could be a severe recession late 2025, 2026. What we think now is there could be a recession late 2025, 2026, but less severe, but longer term. That, we had thought that we'd see a severe recession and then an anemic recovery. Now what we're thinking is a longer term recession and then an anemic recovery. And that could obviously weigh on copper. But the reality is that we are, as a world, moving toward more electrification. We're going to need more copper. And capital formation in the copper industry has been hampered by a variety of long-term constraints, including centralization of ownership, which limits the amount of copper productive capacity development. So we're pretty much bullish on copper in the long run, but with the proviso that we don't expect economic activity to be as strong in the next 10 years as it has been in the past 40 years.
Okay, excellent. And final question, do you have a message for, people who are looking at the gold market, looking at precious metals? We've seen this big run up. What do you have to say to, the person on the street that's looking at this and going, oh, maybe I should buy some gold? Do you have any thoughts for them?
Well, on the one hand, we always say that we think that everybody, if they can afford it, should have some gold, or silver if they can't afford an ounce of gold. That, we think that gold and silver play a very important role in private wealth holdings, and you should have some. But you need to heed what Warren Buffett says about his own investment strategy. He says, I never invest in anything that I don't understand. And if I can't understand it, I don't buy it. And with gold and silver, unlike stocks, stocks and bonds have regulations about accurate disclosure of information. The gold and silver physical markets have nothing like that. And they are full of misinformation and information that's provided by people who have a vested interest in convincing you to buy gold and silver. And you really have to approach your investments in gold and silver by doing the self-education and really getting to know it, and to having you've got to be very suspicious about, when I was in journalism school, one of the things that the professors told us was, when you're interviewing someone, you always have to think, why is this person telling me anything? People pay me to tell them what I think and to get it right. Other people will give you free information. Why are they giving you free information?
A wonderful note to leave it on is to be suspicious, shall we say. Thank you very much, Jeffrey Christian, for all of your enlightened perspective, really, on the gold market and precious metals in general. Thanks for joining us again and sharing your wisdom.
It's always a pleasure.
Thank you once again to Sequent for sponsoring this week's episode of the Northern Miner Podcast. If you want to learn more, visit sequent.com. And thank you once again to Jeffrey Christian for appearing on this week's show. And also thank you, dear listener, for continuing to support this program. If you want to help out the podcast, please leave us a review in the Apple Podcast directory, share it with your friends, and until next week, take care.